Charity may begin at home, but the IRS hasn't gotten the word. Joseph Mohammed Sr., a real estate broker and appraiser living in California, donated real estate to charity. He valued the donated real estate at almost $15 million and claimed a charitable deduction. The issue wasn't that the property wasn't worth what he claimed it was worth. The court said that if anything, he undervalued his donation. But his deduction was denied. Why? Because he had not met the documentation requirements for a charitable donation, in his case, the requirement for an independent appraisal. The tax court said, quote, "We recognize this result is harsh. A complete denial of a charitable deduction to a couple that did not overvalue and may well have undervalued their contributions. All reported on forms that even to the court's eyes seem likely to mislead someone who didn't read the instructions. But Congress was quite specific about what the charitably inclined have to do to defend their deductions, and we cannot, in a single sympathetic case, undermine those rules. The rules for determining the amount of your charitable contribution, the amount you are allowed to deduct, and the documentation requirements are extremely complex. One important rule is that you can donate certain appreciated property that you have held for more than a year and get a charitable deduction for the full fair market value of the property without ever having to pay tax on the gain. For example, take a founder of a startup company who formed his company paying $1 a share for the stock. Years later, his stock is worth $1 million a share. If he donates a share of stock to charity, his charitable donation is $1 million, subject to certain limitations we will discuss, and he never pays tax on the appreciation. The charity gets $1 million, and he gets $1 million deduction. If he sold the stock first, he would have had to pay about $150,000 in income taxes and only have $850,000 left to donate to charity. You come out ahead by your donation of appreciated property rather than selling the property and donating the cash. The flip side is that if you donate property that's gone down in value, the donation will not trigger the loss. In that case, you're better off selling the property first, recognizing the tax loss, and donating the sale proceeds. There are also limitations on how much of your income you can offset with charitable contributions. You are limited to either 30% or 50% of your adjusted gross income, depending on the nature of the property donated, the nature of the charity to which it is donated, and the use to which the charity puts your donation. But our main focus today is on the documentation rules. Over recent years, the documentation requirements to obtain any deduction have grown more stringent. And as Mr. Mohammed learned, the failure to comply with the letter of the law is grave. Let's take a look at some of these rules. For donations of money, the rules depend upon whether the amount was less than $250 or $250 or more. For gifts under $250, there must either be a bank record of the gift or an acknowledgement of receipt by the charity showing the charity's name, address, and the amount of the contribution. No more dropping cash into the collection box and taking a charitable deduction. If the donation is $250 or more, you must get written confirmation from the charity. Bank records are no longer good enough. And the confirmation must also state whether you were provided any goods or services in return for your donation. If you did receive something back, dinner, or all back recordings of Prairie Home Companion for your NPR pledge drive donation, the value of what you receive must be stated on the receipt and deducted from your donation. It gets worse. You must have your documentation before the date you file your tax return, or the due date of the tax return, including extensions, whichever is earlier. A taxpayer was recently denied his charitable deductions, which everyone agreed had been made, and for which the taxpayer had canceled checks. But canceled checks are not good enough for donations of $250 or more. The taxpayer later got complete receipts from all the charities to which they had donated, but it was too late. They were denied the deduction because they didn't have the receipts when they filed their tax return. For donations of property, the rules are even more complex. Different rules for property worth less than $250, $250 to $500, $501 to $5,000, $5,001 to $500,000, and for donations of more than $500,000. At the lowest level, you need either a receipt or reliable written records. They must show the name of the charity, the date and the location of the donation, and a reasonably detailed description of the property. If you are relying on written records, they must also include the value of the property. This rule was a hard lesson for Ed Roberts, also a California resident, who claimed $28,655 in non-cash charitable contributions. He said he donated used clothing, towels, sheets, books, the kind of thing you might bring to someplace like Goodwill. His deduction was denied because of vague descriptions of the property donated. He claimed having donated 4 bags of clothes, and that just wasn't good enough. Even detailed records might not be enough. To deduct used clothes or household goods, now you get no deduction unless they are in good use condition or better, something the taxpayer must be able to prove, unless your donation exceeds $500, and then you need a qualified appraisal for what you donated. Once the non-cash donation exceeds $250, you must get a receipt from the charity. As the value goes higher, there are requirements for an independent appraisal, and at the highest levels, that appraisal must be attached to the return. Remember Mr. Mohammed? It was the independent appraisal requirement that was his charitable downfall. There are some other tricky rules. There was an industry recently of donating cars to charity. People would have an old clunker towed in and claim a charitable deduction equal to the highest Kelley Blue Book amount they could find. Of course, you weren't entitled to claim more than the actual fair market value of the car you donated, but now you have another limitation to deal with. Your donation is the lower of the true fair market value of the car or the price at which the charity sold your donated car, whichever one is less. There are other rules for donations to religious institutions. You get a deduction for your donation, assuming you've met all the documentation requirements, even though you're receiving an intangible religious benefit in exchange. But tuition payments for religious school are not deductible, even if paid to a tax-exempt or religious institution. We have just scratched the surface of these rules. Be sure to consult with your tax advisor to make sure you're dotting your I's and crossing your T's. Otherwise, that charitable donation may give you a warm feeling in your heart, but no tax savings in your pocket.